Ideas out there, just put it up there. We'll see what we can do. Hey, welcome to the Closing Beat, everybody. Happy Thursday. How you doing out there? Good. Glad to hear it. We're financial advisors here at Jazz Wealth, and we like to talk about the stock market. We've got a lot to cover today, so we're going to get right into it. Also, our Jazz After Dark tonight, if you are someone who is kind of active in the market, more of a trader, investor, then you may like what we have. We're going to talk about how to trade like a pro using money management, not your strategy. I'm going to make the argument that your strategy is irrelevant until you can tell me some of the stats about your trades, and I'll show you a spreadsheet, hopefully get you thinking in the right direction there. And then Wine and Wealth here tonight for clients. We're going to talk about the sequence of returns, and I'm just going to draw it on a board. We're going to make it real simple to understand, kind of for beginners, so you can understand when we say sequence of return risks, what in the world is that? How does that work? Why do I care? So we'll go over that tonight. We've got a busy night, but of course I'm here with you guys right now. If you want to play a game, jazzwealth.com/guess the Dow. You can take a shot to win $100. It's a gift card. We're not collecting emails. We don't care, much about you after you win or don't win. So it's not like a game or anything other than to win the money. All right, let's get into it here. So we've got the stock market ever so slightly hinting at trying to break this high. Earnings season will make that decision for you, but now you know where we stand earnings season wise because the bar has been set really low. We've explained that. I actually sat in on a unbelievably interesting Goldman Sachs strategy talk that they had for, well, I don't know who it was for, but I got the invite, and you talk about I'd say 50% of the words they said I've never heard before in my life. It's very, very cool. But a lot of talk about earnings season, the bar being set low, how to expect and what to expect going forward. I do want to point out that for earnings season, if you look at the options market, implied volatility has very little range. In fact, the implied move in the S&P is 4.4%, meaning plus or minus 4.4%. That is very little. That means very small. That means there's very little fear in this earnings season outside of maybe some of the smaller regional banks because the bar's been set so low. So even if earnings come in as expected, we go, well, that wasn't great, but could have been worse, I guess. So very little fear expected. So if we start off earnings season tomorrow with the banks and stuff, and it proves to be something otherwise, you might get something outside of that range. But right now, people are not planning, or the major participants are not planning for there to be large volatile swings. Now, just like we talked about yesterday, this is not true for individual stocks. It's a whole different game that can be played with individual stocks. For example, and I'll just bounce over here to kind of play with this here. For example, something like a Tesla. So Tesla will have earnings on the 19th there. The implied move is 8.6%. So that's wider than expected there. And so that has what you would say is a higher probability of an upside move in this case, if you were to be really geeky about it. A couple others I'll point out. Something like Enphase, the implied move is 9.5%. In other words, people believe that earnings are going to be reported and the stock will go up as much as 9.5% or down as much as 9.5%. That's your range. Anything outside of that is just not being predicted at the moment. And so that one, you can use a handful of different models that you like to apply to that. You have a probability, that's a smaller probability, upside of about 53.8%. There's a lot of action in that solar space. I don't know why, a little excitement there. First Solar implied move is plus or minus 6%. And I do want to say that there's a lot of banks when I ran a scan here. There's a ton of banks with really, really extreme projected moves. For example, Truist Financial, 11% plus or minus. The worst of all of them was Zion Bank. No, I'm sorry. That's not the worst of all. So Zion Bank, 16.4%. Comerica ranks at the highest with 16.7%. KeyCorp, by the way, at 13%. So if you're not sure what that means, all I'm really saying there is in those banks, you know, if you see large, wild moves, it's already being sort of priced into the stock. So it is very likely not going to be a non-event. That's where all the fireworks will be going off. And the good news is you'll be finding out about that sooner because all those banks report early in the season there. So just a little something to point out if you are interested. If you're not. Oh, by the way, on the downside, do I have a list? Let's do this real quick. On the downside, the smallest projected move is Kimberly-Clark. Kimberly-Clark. There you go. Projecting less than a 1% move on the downside and having more of a downside bias to it. Lockheed Martin. I didn't prepare this list, so I'm just going through by looking at it. Lockheed Martin, which we'll report in just a couple days, actually, they are 1.5%. So what does that mean? What are we saying here? So any stock that has a small range of possibilities where people are placing their bets, no real further than 1.5% up, 1.5% down, if there's a larger move than that, you get a wild day. You get one of those days that it's like a blast off and go, or a gap and go, as they say. Gap's up 3%. All of the money is bet in that 1.5 to minus 1.5% range. Therefore, all of that big money is wrong. And so adjustments have to be made depending on what the position is. So what ends up happening is all those adjustments get made and the stock volume, the actual range for the day is much wider than expected. It's really, really kind of cool to watch if you see it coming, if you're participating ahead of time or happen to look at that sort of stuff. So anyways, a little bit different way to look at things there. All right, the S&P here today, that is officially the 10th best day of the year. I could just pop over here and show you. If you take a look at this year, that ranks right in here, number 10, 1.33%. Here is a list of, it's really like 18 days. I just looked at all the days that gained more than 1%, plotted them on a chart for you so you could see January 6th was the best. Typically, that is the case where the first day of the year is your better one. If it's not the first couple days or so. January 1.89% and so on until you get down to the 10th best day of the year. Notice something interesting. The 10 best days of the year make up more than the total year-to-date gains in the market. Do they not? Quite a bit more. This goes back to my argument. We were doing this on Jazz After Dark. You can't miss the 10 best days in the market. And I had a little fun with this before the show. Here we go. Just since COVID, because I didn't want to go ahead of it and say, oh, well, that was a big downturn. Like you can't include that. You're cherry picking dates. So I went to just before COVID and said, well, what happens if you missed the best 5 days in the market and the best 10 days? Well, if you just stayed in the market, you're up over 24% now. If you missed the best 5 days, only 5 days, and COVID, feels like an eternity at this point, you'd be down 13%. So while the market's recovering, everything's good, if you said, I don't know about this COVID thing, I'm going to get out of here and just sit back and see what happens, you have a very, very steep uphill battle to fight. If you happen to be out of the market for just the 10 best days, only 10, keep in mind, I'm not saying oh, pick all the best days and just get out of the way. No, just 10, you'd be down 30% at this point. You've got years until you can recover from that. So just one of those things. And I want to point that out again because, if you're going to say, let me get out of the market, you better have impeccable timing. Out and into cash, I should say. All right, jobless claims came in about 4,000 higher than expected, but still at a historic low. Now, we can get away with saying that for a while. You notice how they say that on TV and in the articles and stuff? All right, it's still near a historic low, so it's really not bad that it was higher than expected. You can only get away with that for so long before we go, yeah, that's about average. I don't like that anymore. So for the moment, and there's what happens there. I get a phone call while we're talking. For a moment, we can buy that. We can say, that's me being on the fence with you. Like before, I was all like soft landing. I'll take that and say, yeah, okay, that's not good. I'll take your side on that one for those of you that want to say things are about to get rough. So we'll see. Now, yesterday, I told you how in our Notes from Jazz, I had previously kind of outlined this for clients, and we talked about Inflation. If inflation only gains 0.1% month over month, how fast can we get down to different targets? So I went back and I pulled it for you because I don't like doing that. I don't like saying something and then like teasing you and stuff. So here's what we actually shared with clients. So this took a while to put together. We no, this was a month and a half ago. But what we did is we said, let's plot each rate of month over month inflation and then see where the target headline inflation rate would be. So for example, in orange, if inflation were flat month over month, which it hasn't been, but if it were, that would be our fastest base case to get down to 2% in May of 2023. That's next month, but we have not had flat inflation, right? What did we look at yesterday? We had inflation that was 0.1%. So that's in your gray line if you want to look. That's the next one up there. So you say, okay, well, the Fed wants inflation around 2%. At what point do we hit that? About late, I'd say early June, right in there. My bad for not including the extra month in there. If you say, well, that was just 1 month, I don't know. We're currently averaging 0.23% month over month since the peak in inflation. So you say, okay, well, let's take the 0.2 number and just go a little bit above that there. You see that we have a recipe for getting down to about 2.5% before we would need to see, some of that older data bleed off the charts. We can't go lower than that effectively with this data over here, right? Because we're doing the month over month data, but the headline number is for a full year. So after, let's go into like, where is it? 2020, here we go. So we're like in April. So we have the highest numbers on record right now, sort of fudging that number and causing the year over year number to stay a little bit higher. Once we move on to the next month, this goes away and this is the new highest number. Then the next month, this and so on. So that's why I pointed out before, inflation won't just go down and then stop. It's going to go down and you're going to see it start to go back up again. And the Fed already knows that. They tried to explain it in a really silly, geeky kind of a way. Now you know. If your last number, so let's say number 1 is 8%, number 2 is 7%, number 3 is 7%, number 4 is 5%, and so on and so on. You take the average of that and then you're going to get whatever it is. Well, if the next time you do it, you drop the 8 and you move forward, oh, okay, the average changed a little bit. Once we drop off all those high numbers, it becomes increasingly harder for inflation not to show that it's upticking. So probably a poor explanation on my part. But hey, more of that to come. So there you go, if you are interested. So I wanted to share that with you because often I do tease you about what we share with clients and I don't get around to actually sharing it. And well, that's not right. All right, let's look at the sectors here real quick. Well, we got to start with healthcare. Healthcare remains and is the most overbought sector in the S&P 500. It is also the only sector that was overbought and became more overbought, if you track it that way, right? Every other sector, for example, consumer staples was overbought. There you go. A little bit overbought there. It remains in overbought territory, but has not extended itself. Right? The biggest sector that has made the biggest move would be industrials. This is week over week, I should say, by the way, not like month over month or anything. Biggest week over the last 5 days has been right here in industrials, still very much in a neutral kind of area. It's not overbought, oversold or anything, so a little tough to judge direction there. And then you have materials. That is the second biggest mover in the last 5 days. So something to point out there. Other than that, when you look around the sectors, some of the more boring ones, not much happening in utilities, not much happening in communication services, ever so slightly higher, but not too much there. And also, aside from today, not much happening in the S&P. So just something maybe a little different that we don't often talk about. And I'm sorry, you couldn't actually see those charts, so I'll do better. Okay, let's do some stocks in the news. We're going to have a lot of them next week, of course, because we'll have earnings coming out. And we may go back to doing it the old-fashioned way with the data that we used to show, but we'll see. Delta, weaker than expected earnings. Revenue's a little bit better than expected. Total travel was down. So the main, headline from all of this, total travel was down. It missed expectations, right? So less people traveling. However, the amount of money made per person per mile that traveled on Delta was up by 2%. And that sort of shifted the balance back to neutral. So it really wasn't a bad earnings report. It wasn't great, but that might be why you don't see such a big move there today. Not bad. A lot better than Americans' pre-announcement yesterday. Occidental Petroleum says, hey, everything in the Permian Basin, we've got a lot more to produce there. A lot of excitement around that. It was already baked into the price, however, because they had given this out on their, they did an investor dinner kind of a thing where you could ask questions. So that was already known. Now it's become public and didn't really move the stock much, but it was in the news. IBM, the company, is apparently looking to sell off its weather business, and they put a value on this thing. I think it was $10 billion. It was something astronomical. So good luck, but that's what they did. Fastenal. Better than expected earnings, revenues better than expected, margins a little bit tighter, still a problem there. So a lot of people still trying to work their way back. And going forward, they too had used the word recession 22 times in their earnings report. So algorithms ding them a little bit for that one. Alibaba says, SoftBank's looking to sell basically out of the whole position for them. That's probably what hurt the stock yesterday because that came out overnight. And today, not so much. Little recovery rally there, but not too big of a deal. Remember, earnings season starts tomorrow. That will take the focus. We have BlackRock, Citigroup, JP Morgan, PNC Bank, Wells Fargo, and then UNH. What happens if UNH gaps up dramatically? Any guesses? What do you think? Let's say UNH has earnings, blows it out of the water, it gaps up here. First of all, the Dow would be up for the day. At least it would start that way. However, you have a very attractive pattern for profit taking, for day traders, for swing traders, option sellers. Very attractive pattern there, which would likely put the cap on anything that happens for UNH. Just as a heads up. If you are trading in the markets and you're like, I don't know, am I doing good? Am I doing bad? I'll give you the exact stats. We're going to go over that here tonight. Jazz After Dark, come back to that channel, 7 o'clock, and it will be up there. A real methodical way to think about this, because a lot of people kind of treat this like your personal budget. You're like, yeah, I got the gist of it. I know the numbers. Yeah, oh, cables, what? Oh my God, it costs a lot. We're going to go into the details of it, get you to really think about it differently and statistically, rather than getting emotional and saying, I think the stock's going to go higher because Snoop Dogg just partnered with them or something. Like, come on. Come on. Give me a break. All right, I'll try to take your questions if you have any. Otherwise, I'm going to get ready for Jazz After Dark, Wine and Wealth. We're doing it. We got a busy night here tonight for you. AJ guessed it right there. Yeah. Start with a high price, work your way down there. Kirk, I think you're right. Restaurants have no incentive to lower prices at the moment. Yeah. Oh, yeah. If you were out the top 10 days, you would likely also be out some of the bottom 10 days, would you? Could be. Yeah. If you were out, so the thing is, the best 10 days come during or after the worst. They come during the most volatile times in the market. So chances are you would have been out on that down move going, I can't take it anymore, I want to get out. And then you find that you're missing those best days. So you took the bulk of the loss. Let's say you took 80% of the loss, or even 50%. You took 50% of the loss before you threw in the towel, and at that very moment, you're going to start missing the best 10 days, man. That is horrible. And I've watched it happen. We value every single one of our clients here, but if they won't take my advice, then there's no sense in working with us. So we've had to let a few people go over time. Yeah. What do you think of Plantair? Not much. There shouldn't be much to talk about there. I don't recall there being a big move today, and there was not. So it's essentially flat, dead money, very difficult. You're looking for that news-driven, maybe earnings-driven event to kickstart things, but I wouldn't want to be the one that guesses that. Yeah. Chris, can you do a video? Can you do a video for your clients on past performance of each one of your Jazz portfolios? We do. The last one was on the aggressive stock fund. I believe I touched on a large cap one as well. And then as we add cash back into it, I like to give updates and stuff. But yes, absolutely. That's like my favorite thing to do. Sadly, as I've said before, it's our least watched videos by clients. Like, they don't care, but I like talking about it. So if you go in the dojo, scroll back just a couple classes, you're going to find it. Yeah. Doc's given a reminder that the 2022 IRA contribution needs to happen And now it needs to be in your account. You can't schedule it on Monday and go, well, I scheduled it. No, it's got to be in your account. The actual deposit date has to be that, or you've missed it and it will count for the next year, which is, it's not a bad thing. It's just you can't go back in time from that point. So don't do that. All right, I'm going to take this sucker over here and put this back. I'm going to get ready for our Jazz After Dark and Wine and Wealth here tonight. Going to be some good ones. Hope you'll check us out and enjoy the rest of your day. Thanks so much for watching, and adios.